Hello, everyone. It is Mr. Fernandez, and we are very close to finishing up our conversation on taxation and how we determine what our actual take home or our net income actually is. So we've looked at, in a previous video, our federal income tax. And so we have, based on 150,000, which, let me remind you, is quite high of an income. The average income in Canada is about $55,000 per person. 150,000, it's almost 100,000 more. It's not the norm. But for our example, it's really good because it can hit the three taxation levels. So our total tax obligation at the federal level is $30,000, almost 31. Then we also have our provincial tax income, which our obligation is about $13,000. So the next step, now that we have both of our taxation obligations, we need to figure out, well, how much money are we left over with? And that's honestly the really easy part. So we take our gross income, so the total amount of money we make before any deductions. And like I said, that was $150,000. So our gross income, $150,000 right there. Then we are going to take our federal tax, which was $30,000. It was $30,991.78. And so we have that there as well. And then we take our provincial tax. And that is $13,107.07. Boom, we have those three. And we are going to subtract those two numbers, the 30,000 and the 13,000, from our total 150. So we go to a lovely calculator, because again, we could do this ourselves, but why bother? 150,000 minus $30,991.78, and then minus again $13,107.07. And that gives us a total of $105,901.15. And that, everyone, is our net income. Bam, there it is. It's gorgeous. So we have approximately $45,000 in tax obligations. And now this 105,000, like I said, that's our net income. That's our take-home pay. That is how much money after the tax obligations we actually put in our pocket. It's not entirely what we put away into our pocket. There are a couple other obligations that are smaller and harder to predict. And so what I usually recommend is you look at your first pay stub and you can see what those deductions are. It's your Canadian pension plan and such. The amount taken off is not huge, so you don't have to be too worried in terms of it fluctuating greatly. Just kind of build in a little bit of that in your budget. Now, we have this number. Well, bam. And in a previous video, we figured out, if we know our hourly income, how to get to our yearly. But now we have our yearly income, our takeaway, and we want to build a budget around that. When you get to certain levels of employment and certain styles of employment, you are given a salary rather than an hourly income. So for example, when you work in retail, you will be hired and you'll be told, oh, you make $15 an hour or $17 an hour or $14 an hour. In other professions, you're not told that. You're told, this is how much you make per year. Well, great. I'm not building a budget based on a year, though. I'm building a budget for every week or 2 weeks or month. I'm using much smaller timeframes. So how do I take this money and figure out how much I have to spend in that time frame? Well, super easy, actually. You're going to take your annual net income, your ANI, Annie, just made that up, super clever. You are going to divide that by the time frame. And then that will give you the income in the time frame, your ITF. So annual net income divided by the time frame equals your income in the time frame. So let's say we want to figure out how much we make per week. That's a good one to start with. So our annual net income is $105,901.15. We are going to divide that by, well, how many weeks are in a year? If you said 52, you are correct. So we want to figure out how much we're going to make per week. So we divide that by 52. And again, because I don't want to have to actually do the long division of it all, $105,901.15 divided by 52. Nope, that's a 1, 52. Perfect. And so our take-home pay for each week would be $2,036.56. So our weekly income equals $2,036.56. Right there. Look at that. We know how much we make. And that's great. Some people will make a weekly budget. I'm not huge into weekly budgets. I usually make monthly budgets. That's kind of how I do my thing. Now, there's a couple of ways to do your monthly budget. And some people prefer it one way, some people prefer it the other way. And I'll explain the two ways first, and then you can decide which one that you prefer. And I'll also offer which one I prefer. You take your weekly income and you multiply that over each month's number of weeks. Because as we know, some months have 4 weeks and some months have 5 weeks. So you could take your weekly income and say, okay, let's say the month of July has 5 weeks in it. I'll take my weekly income and multiply that by 5. And that's my monthly income, and I'll base my budget off that. And some people like that. I don't, because it changes each week. What people will do is they will take their weekly income and times it by 4, because there's 4 weeks in a month. Now, if you were to do that math, the 4 weeks into a month, you would actually realize that it's only using 48 of the 52 weeks. And that's what I'd like. I'm actually planning to use less money. And the reason for that is there are some months that have extra weeks and some months that have the typical 4. And so in those months that have the extra weeks, which means there might be an extra pay coming in, that's just extra money that I haven't planned to use. I've built in a buffer, a barrier, that if something were to happen, some sort of emergency, on top of the money that I'm already saving, every paycheck going into an emergency savings account, I also have those paychecks that it's just extra cash flowing my way. So what we're going to do is we will take our weekly income and times it by 4, and that will give us our monthly income. So we have $2,036.56 times that by 4. Let's pull up the calculator. $2,036.56 times 4. That gives us a grand total of $8,146.24 for a monthly income. Excellent. And now what you can do with that monthly income is start looking at where you want to spend it. I usually suggest you look at the biggest expenses, which are typically your living expenses. So if you're renting an apartment or you're paying for a mortgage, those are your largest expenses, and then you go down. In another video, we'll talk about fixed versus variable spending, but that's really it. You take your taxes, subtract it from your gross income, and that leaves you with your net income, the amount of money you're actually going to take home. And then you can divide that out, do whatever fun formulas you want for the budget that works for you. I happen to like using a monthly budget. I find it works really well. And then you're able to figure out what you have to spend and what you should save. And maybe you can't afford something that you want to afford. Maybe you can't afford to spend $600 on clothes in a month, and you can only spend $75. Not unusual. So you have to make those choices. All right. If you have any questions, comments, or concerns, as always, let me know. Have a great one, and bye.